This has a bunch of transaction information up here, up top. And then it's got this little journal entry worksheet at the bottom. And so they're giving us all this information, and they want us to create the journal entries.
Mm-hmm.
So I'm just going to kind of walk you through like the process I would use. And if it's helpful, then we'll keep going. And if you're like, nope, that doesn't help me at all, then we'll try to find another way to look at it.
Mm-hmm.
So on June 1st, T. James, the owner, invested $17,500 cash in Sustained Company in exchange for common stock. So what I have to do is ask myself first, like, what's happening? And if the owner's putting money into the company, that means the business's cash will be increasing. And the common stock, which represents investments by the owner, will also be increasing. Then I have to ask myself, what type of accounts are these? Cash is an asset account, and common stock is an equity account. And then I ask myself, what are the rules? So if an asset's increasing, that would be a debit to the asset. And if common stock is increasing, that would be a credit. Then I'm ready to make the journal entry. I can say, we're going to debit cash and credit common stock. And that's 17,500 each. And record my entry. So that's my process. If I'm still not feeling super strong about that process,
Mm-hmm.
then maybe I'll have to bring up my little informational sheet here. And where did that problem go? I got too many windows open. My wife doesn't appreciate my love of having everything open all at once. Let's see. And maybe this is why. Okay. So this will help me a little bit. So on the second one, it says the company purchases $10,500 worth of furniture. And it says it purchases it on credit. And so when it says that it purchases it on credit, it means I'm not paying cash for it. It means that I'm going to pay in the future. Okay. And so again, I say, okay, my furniture is going to go up. Furniture is an asset. So that will go up with a debit. And then since I'm not paying cash, my liability accounts payable is going to be going up. And liabilities increase with a credit. So I can say furniture is my debit and accounts payable is my credit. And the amount was 10,500. So in my brain, every time I do a transaction, I'm going through this process of saying, what accounts are impacted? What type of accounts are they? And what are the rules for those types of accounts? And it takes practice, right? You get better at it the more you do. So here the company pays $1,900 cash for a 12-month prepaid insurance policy. So we do know that our cash will be going down in this transaction because we're paying cash. And then we know that our prepaid insurance policy, so prepaid insurance, will be going up. So then I ask myself, what type of accounts are they? Well, cash is an asset. So if it's going down, then that's going to be my credit entry. And prepaid insurance is also an asset. And so if it's going up, then that will be my debit entry. And then the amount is 1,900. Oops. So Emmeline, is this helpful at all to walk
Yes,
through it this way?
I think that the debit and credit rules, I think that's helping me.
Okay, yeah. So I'll walk through some more the rest of them and just to kind of explain my process. The good news is after you've done it like 20 years, if you want to do it for 20 years, the good news is that this happens pretty much, this whole process of like saying what type of account, it all just happens kind of automatically in your brain because you do it a lot. If you're a piano player, you know what I mean by that. When you're learning a song, it's really hard and halting and you have to work through it. But after you get used to it, it just sort of flows. And so it's like any other skill. So here, the company billed a customer $9,500 for services, sustainability services provided. So if I bill a customer, but they haven't paid me yet, then I know my cash isn't going up. So instead, my accounts receivable will be going up. That's money owed to me by my customer. Accounts receivable is an asset. So if it's increasing, that'll be a debit. And then if I've already provided the services to the person, to the customer, then that means I've earned revenue. So it's going to be services revenue. Revenue increases with a credit. So there's my entry. If we were to translate this into normal everyday English, we'd be saying, I earned $9,500 by providing services to somebody, but I'm not receiving it in cash yet. Instead, I'm billing them and they owe it to me, and I'll receive it in cash in the future. Let's see. The company pays $10,500 cash toward the payable from the June 2nd furniture purchase. So we know if they're paying money, that means their cash is going to go down. And since cash is an asset, that will be our credit, is the reduction in cash. And then if we had a payable, that's a liability. If we're paying it off, that means our liability is going to be going down because we're paying off our debt. So the liability will decrease with the debit. So that's what our journal entry will look like. Again, if you translate that into normal language, you'd be saying, I'm paying off a debt that I owe, accounts payable, with cash. So my cash is going down and my accounts payable is going down too. Here we have the company collects $9,500 cash for services billed on June 4th. So now our accounts receivable is going to go down because we're collecting the money, and our cash is going to go up. So cash is an asset, it will increase with a debit. And accounts receivable is an asset, so it will decrease with credit. Again, put that into plain language. What we're saying is we're collecting the money that's owed to us. So our cash goes up and the receivable goes down, meaning it's no longer owed to us because we've collected it. T. James invests an additional $16,500 cash in the company in exchange for common stock. So again, our cash goes up. That's an asset, so we'll increase it with a debit. And our common stock goes up. That's an equity account, and so we'll increase that with a credit. Finally, the company receives $11,500 cash from a client for sustainability services for the next 3 months. So here we're receiving cash, but we haven't earned it yet, right? And in the previous one, we received cash, but it was for something that some work we'd already done. So here it's a little different. First of all, our cash still goes up, so that's a debit to the cash account. But then because we haven't earned the revenue yet, we're going to record this as something called unearned revenue. And unearned revenue, even though it has revenue in its name, it's actually a liability. It means we owe the customer. If the customer pays me $11,500, I either owe him his money back or I owe him the services I promised to perform in the future, one of those two things. So that's what that entry will look like. And that's it. I guess we could check our work. Make sure I didn't mess it up somehow. Hooray.